Hey everybody, Marty Mazur. Good morning, December 24th, 2018. Very Merry Christmas to you and yours. In light of today's 635 point hit to the Dow, I thought I'd pop in and do a little charting with you. I promise not to take too much of your time this morning. In front of you is our live S&P 500 chart. This is the 1-day, 1-minute chart. Market closed early today, 10 a.m. Pacific time. If you'll recall, last week I posted just a very short clip of a trader in the pits telling everyone that pretty much the buyers have taken the rest of the year off. And I suggested that could be a really rough week next week. Well, here we are Monday. And of course, we're starting off really rough for the markets. I said earlier today that the market is 100% at the mercy of short-term traders who are basically trading the headlines and the intraday support and resistance levels. Make no mistake, that's what's happening today. This 600 plus point decline has nothing to do with anything fundamental. So the market started careening down. This is the S&P 500, but I know a lot of us thinking downturn. Dow was down 400 plus points. And then we saw an interesting amount of volume come in and a really strong, sharp rise here. Now, playing support and resistance levels, I would have thought that we'd lose that right in here. And sure enough, some selling came in, but as you can see, it actually became support and it held pretty nicely. And then we had a big thrust higher. Suddenly it began to look like, maybe we get somewhat of a relief rally. Now, I did suggest in the blog post that that's highly unlikely. It's probably too soon for that. But it was interesting to see. Right here, a tweet from Washington came out criticizing the Fed, basically saying, quote, that the Fed has no touch for the market and doesn't understand, among other things, necessary trade wars. Of course, that's not going to sit well with the market. The market is looking for this trade war to go away, I promise you. So, huge sell-off all the way down. It was interesting to watch this support level because that one was going to be the big test. But remember what the traders said. The would-be buyers really aren't here in this market. So traders just played with that, and you can see that happening all through here. And that is folks who didn't buy there thought, well, let's see. So there was a lot of back and forth. The bulls and bears were going at it right here. Sure enough, the bears were destined to take over, and we closed right at the daily low, right at that 23, just above that 2350 level. Extending the chart out 3 years, let's see how important that level is. That 2350 takes us back to very critical support right here that began back in February, believe it or not, of last year. And wrestled with it, came up off of it, a really nice rally, tested it, and then we were off to the races. So that was very legitimate support, and we're testing that again right now. Technicians would tell you, if we lose that this week, we're going to test again at about 2250, and then ultimately way down here, now we'd be back in 2016 levels at right around 2200. Some people are calling that as the ultimate potential bottom for all of this. A lot can happen between here and here to avert that much of a decline, but that's really going to rattle some cages between here and here if we get there. And we could get there in the next few days if truly the buyers have gone home till the new year. David Tepper, hedge fund manager who's been concerned about this market, basically was suggesting expect a rough patch in here in October. We were actually saying that back up in here as well. He started buying today. And that makes perfect sense to me. I think the smart money is going to be wading back into this market. In fact, as I suggested earlier, ultimately we end up with these monster relief rallies. Whether or not the next big rally, and it'll come, but whether or not that morphs into a resumption of the bull market above these levels, which we believe the macro environment justifies, really depends on, forgive me for constantly beating this horse, and we need a trade war truce. I just don't, and I was saying that way back here, I just don't know how this bull market gets to resume itself or how the global economy ultimately remains in expansion mode amid the backdrop of a global protracted trade war. What will happen if we do have a trade war truce is, barring any other huge exogenous events or concerns, and we know there's some of those out there, I think we do really well going into 2019 against a backdrop of worry. And typically the market does well as it, quote, climbs a wall of worry. So time will tell. We'll wait and see. Before I switch to another couple of charts, I do want to show you this. This is RSI, or relative strength. We don't use this like traders do. Traders use it for these areas here, these highlighted areas, which I'll talk about in a minute. But we look for divergences, either bearish divergences or bullish divergences, to give us a feel for where the trend might be going forward in the market. For our purposes, the RSI still, believe it or not, gives us a bullish look. Notice from here to here the huge precipitous drop in the S&P 500. Well, that is right here to right here. We still have a higher low on the RSI, and we actually have here a higher high and yet another higher high, while the market was literally falling apart. That tells us that odds favor a trend reversal at some point. But what traders use it for is for short-term buy and sell signals. Below this line is what's considered oversold. Going back a little further, you can see we haven't seen the oversoldness of the market, if you will, at this level since all the way back to the bottom of the correction in 2015. You can see it bottomed. Notice how the price moved kind of sideways, but the RSI had a huge bullish divergence. And sure enough, we had a huge rally. Couldn't overcome those all-time highs, though. Notice the RSI falling apart while the market stayed more level. That was a bearish divergence. Then we got that short-term buy signal. Bullish divergence, see, price level, bullish divergence, higher high. And then we were finally off to the races. Got oversold in here, bounced, got oversold right here, big bounce, got oversold right here, big bounce. In here, it's been interesting. Got oversold right here. Boy, you would have expected a big bounce. The market tried negative trade news. Really oversold. Market tried negative trade news this time. Peter Navarro, trade advisor, comment just killed the rally. Right in here, we never did quite get oversold. We never got oversold again. Right in here, we were heading in that direction, but then we had that optimism over the G20 summit, and we were supposedly going to start working out a deal. Right in there, things began to fall apart a little bit when some of the claims weren't confirmed about the U.S. and China talks. And then in here, market was vacillating around a bit. I'm a tariff man tweet, and that was all she wrote. So here we are today, huge oversold position. This market is ripe for a big bounce, an elevation of short interest. Folks who have sold stocks expecting to buy them lower later. Market moves against them, they cover, and you get these monster rallies. So that's coming. I can't promise when. It may not be this week. It may not be till after the first of the year, and it may come from lower levels still. But ultimately, we get these relief rallies. Whether or not they stick, it really depends on some new optimism in that big issue that I keep talking about. Lastly, a couple other charts I want to share with you, then I'll let you go. Emerging markets relative to the S&P 500 or relative to the U.S. market. EEM is the Emerging Markets Index ETF that tracks the Morgan Stanley Emerging Markets Index against the S&P 500. So this is what you would expect when there's great fear of a global trade war. Emerging markets are not going to do well in that environment. So this is emerging markets underperforming the U.S. market. This is a ratio of EM to the U.S. This is emerging markets dramatically outperforming the U.S. markets. A lot of people are speculating what that means. What that means to me is that the smart money is subtly, and I know this chart doesn't look subtle, but this is just the outperformance of emerging markets over the S&P. They could both be going down. This would just mean emerging markets are going down less. Subtle accumulation, stocks in the areas of the world that would immediately get the biggest boost from an ending of the trade war. Doesn't mean this quote smart money is right. It just means that they are taking what I believe are well-calculated bets in the areas that will immediately get the biggest boost. Make no mistake, folks, if your portfolio is US-centric, like most portfolios are, you'll get the boost well. This will be a global rally, and it'll be very impressive, and it'll be politically important to both sides as they play this game with one another. And lastly, this is more evidence that and this is for lack of a better term, smart money is making a vastly different bet than what price trends currently might suggest. This is the commitment of traders reports for the S&P 500 and the 10-year Treasury bond. Now, these are futures traders, so they're heavily leveraged. They need to be right more than they're wrong because they're really, really exposed to their bets. This is the net positioning, long versus shorts. This is last week's report. This means that on a net basis, more futures traders have gone long or bullish U.S. stocks via the S&P 500 than have gone bearish. That's a pretty positive level when you look back historically. This is the net position for Treasury bonds, and as you can see, traders are net short. I want to contrast this with where they were before the last two recessions. Here they were before the, quote, Great Recession of 2008. Decidedly bearish on stocks, decidedly bullish on defensive bonds. This is where you go if you think the economy's in trouble and it's ready to roll over. Before the tech bubble bursting. Right in here, it looks like traders were pretty much neutral on stocks, but they were getting very bullish on bonds. And sure enough, we had a recession, had a bear market in stocks again. Recession here, bear market in stocks. Not making that bet in any way, shape, or form right here. Futures traders see what I see, and that is a macro backdrop that is not signaling that we need to start worrying about this. What we have is we have a tremendous amount of headline risk and a real legitimate fear that there is an element out there that if it is allowed to persist too far, that would be the trade war, we could end up in a situation like this. The price trends are suggesting that that is a possibility. The fundamentals are not. The really smart money, if you allow me to use that term right now, is betting that things are okay and there's likely a big rally coming, which is going to be very profitable for them and very profitable for them as people buy into stocks and rotate out of bonds. No guarantee that that's going to happen. We're just looking at probabilities and we're looking at positionings and commenting to you accordingly. Thank you as always for watching and listening again. A very Merry Christmas to you and your loved ones, and we'll be back again very soon. Take care. Bye-bye.